crypto taxes. And the topic of the webinar is the last resort. I'm here with the Polygon team, Blake, Phil, Sharon, and Taylor. Hi, guys. And without ado, I would like to introduce you to Blake, who will tell you something about the team, I guess.
Yeah, great. Thanks, Moritz. I'm just going to quickly introduce the team members that we have today. First off is Sharon. She's the co-founder and head of crypto at Polygon Advisory Group, and one of the top crypto CPAs in the US. She's a former Big Four senior tax manager. She's a crypto investor and blockchain enthusiast since 2017. She's a crypto tax specialist since 2018, and CoinTracking's designed the US crypto tax advisor. She's also created the crypto tax online course, and she's a creator and instructor in that course that we have. Next, I want to talk about Phil. Phil is also a co-founder and head of tax at Polygon Advisory Group. He's a crypto investor himself. He's a certified cryptocurrency expert and certified DeFi expert. He's a small business tax expert, a tax controversy expert, and he's the author of many articles that are published on news and media sites such as CoinDesk. He's also one of our instructors and crypto tax experts in one of our online DIY courses. And then lastly here we have Taylor. He's a senior crypto tax manager here at Polygon Advisory Group, and he's a crypto investor and blockchain enthusiast himself. He's also a former Big Four tax consultant specializing in serving blockchain-based companies. He's a former crypto tax subject matter expert at a crypto software company, and he's involved in designing a software tool to help the IRS with crypto tax audits.
Thank you, Blake, for this brief introduction. I think our first speaker is Sharon today, which will be talking about crypto loss deduction. Welcome, Sharon.
All right, thank you, Morris. Let's go to crypto loss deduction. So as you guys know, 2022 was not a good year for crypto, and many people suffered losses, a lot of losses due to market downturn or exchange shutdown, things like that. So one thing we need to remember is even if you have losses, it does not mean you do not need to report. You still need to report everything, all your crypto transactions, because if you don't report, you're not in compliant. Also, if you don't report, you cannot prove indeed you have a loss. Now, capital loss deduction are subject to certain limitations. So we need to be careful, such as the net capital loss deduction you can take every year is only up to $3,000. Also, you need to be careful. Do not just blindly generate a large loss, thinking that the bigger the loss, the better. It's not really that case, just due to the limitation. Of course, if you have capital gains from other sources, such as stock, real estate, whatever capital gains, you can use capital loss. So there's some planning you can do by using different cost basis allocation method. Now, some people are wondering whether they can take a loss deduction for situations such as loss in coins due to hacking scams, someone stole their coins. Those type of situations, unfortunately, are considered personal casualty loss. So under the current tax law, we are unable to take that kind of loss deduction. Another situation is due to the market downturn, many coins became almost worthless. So some people thought they can take a deduction, such as similar to worthless stock deduction, or some people suggest that you can take a abandonment loss deduction because the coin is almost worthless. You can probably take a loss deduction for that. Now, recently, the IRS released a memo. It's called the IRS Memorandum 2023-02011. That memo, clearly says no. As long as you still own the coin, and as long as the coin is still being traded on exchanges in the market, even if the value is so small, it's less than a penny, and you cannot claim either a worthless or abandonment loss deduction. Also, last year, we got several exchanges that went down. So can you take that deduction? Now, if the exchange is totally gone, completely gone, then it's not clear at this point. There's no specific guidance. However, we believe there is an argument you can make that it is an investment loss because it's not your fault. You have no control. The exchange got shut down due to more like a normal business failure. Then it is kind of like an investment loss, a capital loss deduction you can probably take at your cost basis. Another situation is it happened a lot, which is there are several exchanges now going through bankruptcy. People got coins stuck in those exchanges. Can you take a deduction? So the conclusion is you can only take a deduction when the bankruptcy is over, when you know exactly how much you are going to get compensated. Then you can take the remaining coins that you cannot get back at cost, but you have to wait. Now, so that gets to the next question. Then, is there any chance we can still take it when maybe there's a law because there's such a huge loss? So at this point, we do recommend everybody to consider filing extension to wait for more guidance. That probably will put you in a better position rather than you go ahead and file and then you have to later amend. So now let's have Phil talk about extension filing. Phil?
Yeah, thanks, Sharon. If you want to go to the next slide, Taylor, please. Okay. Yeah, as Sharon just mentioned, there was a lot going on in the crypto world this year. There's a lot of uncertainty still. We don't know if we're going to get any sort of guidance before the tax filing deadline. So we recommend anyone with exposure to some of these failed projects and failed exchanges to file an extension. There's a lot of misconceptions around what an extension is and what it does for you. So hopefully we'll clear up some of that today. The first thing is that extending a tax return is not an audit flag. The IRS does not look at extended tax returns any more severely than they do look at any tax return. In fact, the extension itself and filing within the extended deadline counts as a timely filed return. So it's essentially the same as filing everything by April 15th or this year, April 18th, with no extension. It's important to remember that information comes later and later each year around investments, around wages, around interest, and things like that. So the tax season is compressed. So there's always a rush towards the end of March, the beginning of April, to get all this stuff compiled and put into a tax return as quickly as possible. But that's not necessarily the right course of action. Complete and correct return is much better than a halfway done return or a return with errors that's filed by the deadline. So we recommend just about everybody extend. Things you need to remember is that the extension that's granted is an extension of time to file, not an extension of time to pay your tax. Your taxes are still due on the original due date, which this year is April 18th. So when you are extending, it's important to come up with some sort of a reasonable estimate of what you think your overall income will be, and then use that to calculate your tax liability. You may well have to make a payment with the extension to avoid any sort of penalties. And while we're on the topic of penalties, the extension itself avoids the late filing penalty, which is a penalty that kicks in at a rate of 5% per month for returns that aren't filed timely. And again, that extension counts as a timely filing, so you'll get out of that late filing penalty. If you do owe money when you file your final return during the summer or anytime through October, you will be charged interest on that, as well as late payment penalties. But the late payment penalty is 0.5, 0.5% a month, as compared to the late filing penalty, which is 5% a month. So it's a much better deal to extend your tax return timely so that you've got a little bit of breathing room there. There's a number of ways you can extend. You can file on paper, a Form 4868. You can file a payment through IRS Direct Pay, which is available at irs.gov/payments. Or you could work with your tax software or your tax pro to file an extension for you. All of these are acceptable methods. They all count the same as far as what the extension does for you. So it's important this year, especially while there's so much uncertainty going on, we recommend just about everybody extend their return. And if we could go to the next slide. Yeah, we'll talk very briefly about how to handle 1099s that are crypto related. And essentially, the thinking here is that with the infrastructure bill that passed last year, it mandated 1099 reporting for centralized crypto exchanges, just about everybody really. But where this really comes into play is around centralized exchanges. They're supposed to be giving us forms that mirror the traditional brokerage statements called 1099-Bs or consolidated 1099s, in which your gross proceeds from sales is compared to your basis and a gain or loss is calculated. The IRS punted that until next year, so we don't have to worry about that this year. But the end result is that over the last couple of years, we've developed this sort of hodgepodge reporting amongst various exchanges, various platforms and protocols, where 1099s are given. They might not be the correct type of 1099. They probably don't have the correct or all of the relevant information you need on them. And so it's just kind of a fail-safe amongst the exchanges to report something, even though they're not reporting everything that they need to report. And so what does that mean? That means that most of the 1099s that you get from exchanges or platforms will probably not be correct in the sense that they'll be lacking information. One of the big things that we all talk about whenever we discuss crypto is this aspect of transferability, self-custody, things like that. But there are attributes with each crypto asset that move with the asset, but they aren't necessarily transferred with the transfer of the asset itself. And what I mean by that is information, your cost basis, what you paid for it. If you buy an asset on one exchange and then you transfer it to a cold wallet, and then later on down the road, you transfer it to another exchange and sell it, how is that other exchange going to know what you originally paid for it? And there's no real way to do it. So when these exchanges report things, by and large, they're reporting just gross proceeds from sales and no basis information. So if you report that on your tax return, you'll show capital gain or income of that gross amount of sales, which in most cases is probably hugely inflated and would lead to you paying a much higher tax bill than you need to. So anyone who does things across exchanges or across wallets really would benefit from using some sort of crypto tax software to help you track that basis through the various motions and calculate your gain correctly. In our practice, primarily, we use CoinTracking. Think it's the best one out there. And it really helps consolidate information across the various sources, the various exchanges and wallets and platforms and protocols that you use, and boil it all down into one place where you can kind of see everything that happened. And to talk about a couple of the things that are unique to CoinTracking, we've got Taylor.
All righty. Thanks, Bill. So excited to be here and to talk to everybody about some of the issues that we see with our clients that we help. And the main issue is around pricing. So typically pricing in a newer market like crypto, the industry as a whole, has been a pretty big issue just because something that's new has a more difficult time kind of getting a consensus around price. And the two main issues that we see amongst our clients relate to two specific activities that we see these pricing issues. The first, DeFi, which a lot of you are familiar with. The second being NFTs or non-fungible tokens. So typically in a DeFi transaction, a very, very simple example of that is you have a token, a cryptocurrency of some sort, typically a stable coin or one of the main tokens, and you in turn lend that or put it into a liquidity pool. And in doing that, you're basically getting back oftentimes what they call an LP token. This basically is a representation of the amount of crypto that you've put into this liquidity pool. In turn, the is helping to facilitate transactions like on Uniswap, for example. So the receipt of that liquidity pool token typically is something that can get priced, right? So if we give up 1,000 USDC for 1,000 LP tokens, typically know the price is going to be 1,000. Now, where things typically go awry and it gets much more complicated is if we use those LP tokens for something else. So many of you are familiar that you can use those LP tokens to maybe trade for different LP tokens, or you can put those LP tokens into another liquidity pool that is subsequently used to fill other markets and whatnot. So when you're trading those liquidity pool tokens from one to another, the issue is pricing and how to know what the price of those is, because the software can only go so far in pricing if there's not a market always for that. So a software like CoinTracking is great because it allows you to go into actually find the price and price those LP tokens so that you can track base as filling earlier. This is one of the great advantages of having a software is to be able to track some of these things. Trying to do it by hand or in an Excel or something is typically very, very difficult and time consuming. The other issue that we typically see with our clients is NFTs. So NFTs typically are traded for on a platform like OpenSea, where you can go in and you can pay ETH or Solana for an NFT. That being priced is typically not an issue, as Solana and ETH are traded pretty often and have pricing. However, there are often times when NFTs are traded for other NFTs, or a combination of NFTs are being traded for another set of NFTs. And the issue is once we go from one NFT to another, the price of the transaction can be very difficult to find. And so typically if you're using a software, and it will not be able to pull in pricing, and you would have to therefore price those transactions by yourself. So these are the issues that we often see related to crypto pricing.
Thank you so much, Taylor. At this point, I would like to do a little introduction to CoinTracking, if you don't mind. Just switching on my screen. So just a short question. Can everybody see my screen and moving?
Yeah.
Okay, guys. So how to set up your account. In CoinTracking, you can set up your account for free just by clicking on set up for free. One big advantage of CoinTracking is you don't need to enter an email once you want to set up your account. You just can use CoinTracking with a username. Then by clicking on sign up now, you will be able to choose your currency and your language. I will just switch to English. That's maybe better. Oh, okay. This username already exists, so let's just go back once more. Okay. Okay, how to set up your account. You click on sign up for free and use just a username and a password. Just a second. You don't need to enter your email or anything. You just can enter your username, and that's how you set up your account by clicking on sign up now. Then you will be choosing your basic currency and your language. You also could enter a time zone, but that's not necessary. And by clicking on that button, your registration will be done. CoinTracking has some basic features. For example, the dashboard, where you can see an overview of all your coins traded, your actual balance, and the trades in a certain period. For example, your trades per month. But let's dive a little bit deeper. You can enter or import your coins in CoinTracking either manually or by CSV import for, as you can see, lots of exchanges, also via API. We also have some wallet imports or blockchain imports where you can import directly from the blockchain. Our legacy import section is possible for exchanges or wallets that don't exist anymore. So that's basically how you import your transactions into CoinTracking. If you choose the exchange where you import your data from, you will get a step-by-step guidance how to import via API or CSV, whatever you want. If you don't have any data yet, you can enter your coins manually by just clicking on in the enter coin sections on the new sign. You could enter your different transaction types, for example, a typical trade, or some staking rewards, mining rewards, airdrops, or as Taylor already mentioned, the LP section. Those transactions will be later treated tax-wise regarding to the individual tax law in the US, for example. Once we imported all transactions, we will see them later in the tax report. But first of all, to go to another point that Taylor already said, we have an NFT center from CoinTracking. So if there's any coin that the software don't knows because it's an NFT, for example, you can convert this transaction into an NFT. So you basically you will label this coin as an NFT, and as consequence, this transaction will be treated like an NFT for tax purposes. Once we imported everything correctly, we can check this by some basic checks like the missing transaction, duplicate transaction, and validate transactions. Here we can find basically some warnings whether there's some data missing or there are some double transactions or something like that. And we can change that so that we don't have these warnings anymore. Once we did all of that, we can go to the tax report section. Over here, we have some basic settings for our tax report. First of all, we will choose any country, for example, the United States, and the tax year. After that, we have several different setting options. For example, we can choose our cost method or some other basic settings. For example, like Taylor already told us, the liquidity providing section or liquidity providing transactions can be treated differently depending on what the protocol says. So a user or a CPA is able to label liquidity providing transactions as taxable or not. That's some of the advanced settings we got in CoinTracking. But for basic users who don't know much about taxes, we have the standard setting for every country preset. After that, you can generate your report and download your report and see which transactions or what is your taxable gain or loss of this crypto year. Back to you. I think the next speaker will be Sharon with a DIY course. Thank you very much.
Thank you, Morris. So we created a DIY online course to help people to get their crypto taxes done by using CoinTracking, especially at this time. If you are unable to find a crypto tax professional to help you and you have pretty complicated situation, you are unable to just use CoinTracking to do it all by yourself, or you don't have time to learn all the features, figure out everything, we provide this course to help you. So what is special about our course? I know there are probably some other similar courses out there in the market, but this course is created by us, our firm. We specialize in crypto tax calculation services, and we are one of the top crypto tax CPAs in the US, and we are also CoinTracking's US tax partner. So CoinTracking only has one tax partner in every single country, and we represent United States. Our course is designed to provide both crypto tax knowledge as well as practical how-to. We provide a lot of easy to follow practical examples. We showed you exactly how to handle different things in CoinTracking by showing you how to do it in the software on screen, so you can follow very easily. Also, we provide systematic approach to get your crypto tax calculation done step by step by using our proprietary blueprint, which is a blueprint we created actually for our team to do client work. But we are willing to share it with you guys so that you can follow the exact same approach that we use to serve our clients to get things done quickly and correctly. This course is most suitable for people who want a step-by-step guidance to get their crypto taxes done, or they cannot find a crypto tax professional or cannot afford paying a professional to do it for them. So this is a tool, it's very useful tool that you can use to reduce a lot of your time and hustle and headache. Now, let's go over the curriculum of our course to just give you guys an idea about what is in the course itself. Go to the next slide, please. Taylor. All right, so we have three big, main modules. Module 1, we call it Crypto Tax Guide for Dummies. This is a module that we are going to explore the issues, how to handle things from a tax perspective. We will talk about common myths, all right, and taxable versus non-taxable transactions. Some people may still have confusion about what is taxable, what is not taxable. We will clarify that. Tax consequences for using crypto cards, debit card or credit card for spending. Many people don't know how to handle that. Also, debit or credit card rewards. When you use a card, chances are you will get some kind of similar to cash reward for normal credit cards. How to handle those when you receive those rewards, either in crypto or in fiat. Crypto loans are becoming more and more popular. What's the tax treatment for crypto loans? We will talk about that. Of course, we will go over official IRS guidance, all the ones that have been issued so far to help you guys understand each one of them. And the next slide. Okay, we will also talk about how to handle crypto-related IRS notices. This is a very important topic. Many people need to know if they get a notice, what do they do? Also, we will provide an update about the current tax-related regulations, such as FBAR. Do you need to file FBAR? What's the requirement for crypto? Provisions under the infrastructure bill and the watch sale rule, whether you can use it, what to consider, things like that. So next, after all the theories, we start to look at our tools. Okay, how can you get your crypto tax calculation done? Just like Taylor mentioned, it's almost impossible to use Excel, especially if you have a lot of accounts, a lot of different transactions, activities. Now, you need a software. So CoinTracking is the software that we have been using to pretty much serve all our clients, and we personally use it as well. So everybody on our team is personally a crypto investor. So we will talk about why we want to choose CoinTracking. I have personally looked at almost every single crypto tax software in the market. How did we end up using CoinTracking? All right, we will provide a more detailed overview of CoinTracking software and resources provided by CoinTracking. Many people don't know CoinTracking provides a huge database of very useful resources that you can look at, and they're all free. And then also how to get ready before you even start your transaction import into CoinTracking. So those are very important things to know before you start using CoinTracking to do your crypto tax calculation. All right, next, that's the main thing, or the meat about our course, is how to actually get things done. Like I just mentioned, we have a blueprint. It's called Account Reconciliation Blueprint. And so we will first give you an overview of the blueprint, how things work, what are the steps, and then we will go over every single step one by one with actual examples to explain to you the process, the procedure, and how to actually get each step done. So I would say this is a course that you cannot find anywhere else in the market.
Thank you so much for sharing a little bit about the course. Real quick, I just wanted to show you guys the DIY course here, the sales page for it, just so you know how to sign up. This page has all of the same information that Sharon has already discussed with you. I did want to show you, though, how to get instant access. Here at the bottom, you'll see you can get instant access. We normally sell the course for $9.97 right now. But if you click this button and save and put a coupon in, which is save 100, actually be able to get $100 off. So this coupon will only be live for 24 hours. So right now you're watching the webinar, it'll be live for the next 24 hours. And after that, we will, the coupon will no longer be valid. But yeah, just wanted to show you guys how you can sign up for the course and get that. We'll be sure to include the link at the bottom of the description of the video and everything. Wherever you're watching the webinar, we'll make sure you have the link to the course. Perfect. And thanks. And I guess we're going to kick off to some questions that you guys have. I know a lot of questions are coming in. So I'll pass it over to Moritz for questions.
Yeah, thank you, Blake. Yeah, we had a few questions from our community, or some common questions we always get when it comes to crypto taxes in the US or somewhere else. So let's start with the first one. I know I won't be able to calculate my crypto tax on time. What should I do?
Yeah, I'll go ahead and answer that one, Morris. Yeah, it's a common thing that happens, right? It's not unusual if you spend any time in the crypto space, pretty soon you've got 1,000 or 10,000 transactions, and you're looking back at it all, and it's all a big mess, and it's just going to take time to work through. What we talked about earlier, extending your tax return, that's the first step. But beyond that, it's important when you file the extension to get a good estimate of what you think your overall income will be. So between now and April 18th, you need to make some sort of a good faith effort to consolidate your transactions, using a software like CoinTracking to at least get a rough number of what you think your overall income is going to be and calculate the taxability based on that. But that said, once the extension's filed, then you have until October to work through the back office stuff of cleaning all that up and getting ready to actually file your return. But that would be the advice there, would just be to extend.
Thank you very much, Phil. We will just go to the next question. Is there anything I can do to reduce my crypto tax bill over the fiscal year? I trade high volume and values of crypto. Any tips?
Yeah, I can take that one. So I think the biggest thing with reducing a crypto tax bill is knowing where you currently stand throughout the year. So a lot of the times in kind of tax world, we're a little bit at times behind the ball, right? We're kind of waiting for things and kind of doing it the year after. And unfortunately, after the year has ended, there's not much we can do. However, if you're trading crypto pretty heavily throughout the year, you want to use a software like CoinTracking, like we're talking about, so that you can see where you currently stand, and then you can use things with advisors to figure out how to lower your tax bill throughout the year, rather than doing it, after the year when there's not many options that we have.
Okay, so it's always wise to look into everything and be up to date with anything.
Yes.
And talk to advisors, of course. Okay, let's go to the next question. Can doing taxes with a spouse or a partner be beneficial for crypto tax-wise?
Yeah, I'll answer this one. Not specifically from a crypto perspective, but generally speaking, when we talk about filing jointly with a spouse versus filing individually as married filing separately, really what we're talking about is arbitraging the tax brackets. And the tax brackets for married couples are twice as big as they are for single couples. So if you're in a situation where there's an income disparity between you and your spouse, either one or the other makes significantly more, then it there is a possibility to significantly reduce your tax burden if you can put that income on a consolidated return that you file with your spouse and benefit from some of the excess bracket that they have based on their lower income or your lower income. So from a crypto perspective, not really. This is more of kind of a general tax planning question. And in general, it's almost always better for married couples to file jointly for that reason.
Okay, so we have a little tax advantage if we marry. That's something we can do. Thank you very much. Let's go to our next questions. I regularly burn NFTs to receive new ones. For example, I 3 to receive 1 new. How is that taxed?
I can take that one since I talked a little bit about NFTs. This is kind of the perfect example of what I was talking about. So if you're burning 3 NFTs to get a new one, that is seen as a disposal of those 3 that you currently had for 1 new one. So think of it in much in light of what a trade would be for one cryptocurrency for another. However, in this one, you're trading 3 for 1. So it's really, really helpful to have a software that will help show you that those transactions are coming in and that you can go in and manually price to show what the acquisition price of that new one is, which would be the value of those that you're getting rid of.
Thank you so much, Taylor. I guess that was very helpful for everybody in the NFT space. We have another question. How are locked coins taxed? The coins that are theoretically mine, but not for a specific period, I can't access them.
Take this one. Many people, they need to recognize income. Let's say those are reward coins, whether they need to recognize income once they see that in their account, or they can wait until they can take the coin out after that lockup period. So the answer is, I think you can wait, just because when it's being locked up, you do not really have complete control and access to that coin. Therefore, you do not need to recognize it, because the rule is once you have complete control and it's determined, it's fixed, you can do whatever you want with it, whether you leave it there or you take it out. At that time, you do have to recognize the income.
Thank you so much, Sharon. Okay, we are almost at the end. This question is about all the artists out there. I'm a creator of NFTs. How do I pay crypto taxes? Can I claim any costs? If so, what type? For example, electricity, software, etc.
Okay, I will talk about that one as well. So we do have quite a few clients who are NFT artists. Now, if you are doing this as your business, you are in the business of creating NFTs, usually it's considered, when you sell the NFT, it's considered ordinary income and business income. And, it's not a capital gain, because it's not a capital asset in your hands. It's a self-created property and asset or inventory. So you have to recognize ordinary income for it. Now, on the other hand, you are also allowed to deduct associated expenses. So they will not become your cost basis, because that is a concept for investment properties. You pay something to acquire something, then whatever you paid is considered your cost basis. Now, in this situation, whatever cost you have to pay in order to create an NFT, such as here electricity, the software you need to use, any tools you need to buy in order to create an NFT, they are just considered business expenses. So you do have to file, if you are a sole proprietor, you have to file a Schedule C with your personal tax return to report your NFT sales, which is ordinary income, and then take a deduction for all the expenses that you paid. Also, royalty income. So a lot of the NFTs, if you are the creator, once you sell it and when it's being resold, then you most likely will be able to get a certain percentage as royalty income. Now, for those royalty income, they are also considered ordinary income. And again, if you're running this NFT business, as a business, those royalty income will also be considered business income. So you will have to report all of them on your Schedule C. But if you form a entity, then you will have to file a business tax return, and then you will need to report all the income as well as your expenses in the business return.
Thank you so much, Sharon. I think everybody who is a creator of NFTs now knows what to do, especially the question was answered for everything is deductible if it relates to the creation of the NFT. And thank you for the few sentences about royalties and everything of that. So we already reached 40 minutes, so let's go to the last questions. That's a very dramatic one, but I think many people in the crypto space have those kind of questions. What do I do if I haven't disclosed my crypto on a tax form since 2019?
Yeah, I'll answer this one. This is you're right. This is a common question. I think I answer this every week. But the general rule here is that, you know, the IRS, generally speaking, they have a look back period of 3 years during which they can audit you. That goes up to 6 years if your income is substantially understated, which is a 25% factor on any of your returns. But the overall goal here is that, you know, you have to know what to report. So it's important that you kind of start at ground zero and go back with a software like CoinTracking through your entire crypto journey to make sure that you know what you're talking about. Because, you know, there's a lot of stress involved with not being in compliance with the IRS. Maybe you're getting letters and notices in the mail and things like that, and you want to just kind of get that off your plate, get that weight off your shoulders, so you can live your life and be happy. And the first step to doing that is understanding exactly what the taxable implications of everything you've ever done in the space are. Once we know that, once we have a completed crypto reconciliation, we know the taxable implications of what you've done over the last 3 years or 6 years or 10 years, as the case may be, then we can talk about filing returns. Generally speaking, we like to go back 3 years and bring you up into compliance. In certain situations, we'll go back 6 and bring you up into compliance. But the whole goal here is just to make sure that we're reporting what we need to report to the IRS so that you can sleep better at night.
Phil, thank you so much. So the answer is being honest and putting in the elbow grease and just working through everything again and declaring everything as it is supposed to be. Okay, I think we reached the end of this webinar. Thank you so much. That was Blake, Phil, Sharon, and Taylor from the Polygon Advisory Group. I think we helped a lot of people out there in the crypto space. And yeah, there's nothing more to say than thank you and have a nice weekend, guys.
Thank you.
Thanks.
Thanks, everyone.
All right, guys, I'm ending the recording. Thank you so much.